In 2025, I'll be investing over £20 million for my clients. So it's my job to understand all of the risks that could impact their investments and retirement. And based on my research, there are three big risks that could be a lot bigger than you think in 2025. So let's take a look at what these risks are, how to avoid them, and what to do instead. To explain this first one, I'm going to reference something I never imagined I would on this channel, the Eurovision Song Contest. As you may or may not know, you have 26 countries in the final. They all perform one after the other. Competition lasts a few hours, and at the end, the audience and the judges vote for the king or queen of Eurovision. So you would assume that this is judged on merit. In other words, the best song wins. But if you dig into the data, that isn't always the case. Not just on Eurovision, but lots of other popular shows where people perform in sequence, you are much more likely to win if you perform near the end, because the audience is more likely to remember the most recent performances. So how does this apply to investing, and why is it dangerous? Well, imagine you're about to retire. You have a solid portfolio saved up, but you are ever so slightly off your retirement target, and you don't fancy sticking it out at your job for 3 more years. Then one night you're sitting at home reading the news and you see Palantir 256% returns, Nvidia 183% returns, and Vistra 280% returns. And then you look at your pension pot that is bringing you 7% a year on average and you think, yeah, why not? Give me some of that. Well, you would have fallen prey to one of the biggest dangers of 2025, recency bias. More specifically, for 2025, recency bias for US tech stocks. You see, in both the Eurovision Song Contest and investing, humans give greater importance and make decisions based on the most recent events. But this example will show you why it's so dangerous for your money. Between 2020 and 2021, Tesla stock was all the hype, so it flew from $22 a share to more than $200 a share. But then it started crashing straight back down. And you see a similar trend with Meta and Zoom and any hot stock ever in the history of the stock market. And yeah, if you're trading for fun, why not go mad and pick the most interesting stuff? But if you've gambled your retirement savings away on some US tech stock that you don't understand just because it's previously done well, it can have devastating effects on your finances. Remember, past performance is no guide to future performance, especially when it comes to individual stock picking. However, even if you don't fall prey to recency bias, you can't escape this second one because the government is behind it. However, if you're aware of it and know how to manage it, there are ways to avoid paying it. So let's imagine you are already following all of my tips and you have £500,000 invested in a bunch of really well-diversified index funds. And these funds had been making you roughly 10% a year, or in other words, £50,000 profit. Well, for those of you who don't know, when you make profit from stocks and shares, you need to pay tax on that profit. And I'm not just talking about the tax you have to pay on the dividends you receive whilst you hold them. I'm talking about the capital gains tax that becomes payable when you sell them, i.e., when you actually take your profit. And in the recent budget, capital gains tax was raised from 10% to 18% for basic rate taxpayers and from 20 to 24% for higher rate taxpayers. So in the example above, as a basic rate taxpayer, your tax bill could almost double from £5,000 to £9,000 in 2025, which might not seem like that much money in the short term, but over the course of 5, 10, 15 plus years, this could be the difference between one more year stuck in the office or out on the golf course. So how can we get around this? Well, firstly, you can put up to £20,000 annually into an investment ISA to shield all of the investment growth from capital gains tax. You'll also be protected from any income tax on interest earned in here and tax on the dividends you might receive. And secondly, you can contribute to a pension. You get tax relief on your contributions, so your money grows faster, and you can also withdraw 25% of it tax-free when you retire. Not to mention, similar to the ISA, as your investments grow inside of the pension, they will be free of capital gains tax and tax on interest and dividends in the same way. These products are known as tax wrappers. and they help to ring-fence your investments from the taxman and maximize your returns. This is especially important the younger you are, as the more money you keep in the pot, the greater the effect of compound interest over time, which helps accelerate the growth of your money. So reevaluate any investing you are doing right now and make sure you're making the most use of these important tax wrappers. However, I know this can be tricky to get your head around. So if you have any questions, you can apply for one of 5 free calls that I offer to subscribers every month, and I will help you out as best I can. Link in the description. This brings us to number 3, which I think is the riskiest of them all, but not for the reasons you might think. A couple of months ago, we saw Donald Trump voted as the president of the USA for the second time. Now, as I mentioned earlier, nobody can actually predict how the market or individual stocks will perform, but we can assume with some level of certainty that his election will have an impact on the stock market, at least in the short term, whether it's for the good or the bad. And this is where so many people get confused. They assume that by investing in the S&P 500, they're immune to this risk because they've diversified their portfolio, which isn't completely wrong, but this level of diversification simply isn't good enough. Investing in an index like the S&P 500 means that your risk is evenly spread across the biggest companies in the USA. But what happens if the US economy collapses? There is a huge uprising against Trump, or there is civil unrest in the US. These might seem and sound like extreme examples, but given the assassination attempts and violent protests, we can see there is a lot happening in the US at the moment. And we know from the pandemic that the S&P isn't completely bulletproof. So if you have all of your future retirement savings riding on the S&P 500, i.e. the US economy at the moment, that could be a really big risk for 2025 because your portfolio isn't as diversified as you think. To get around this, I recommend you look at more global indexes and spread your bets across different economies. That way, if the US doesn't perform as well as expected, your whole portfolio doesn't take a huge hit. Because aside from the political risk, the S&P 500 isn't quite as safe as you think. There is a big misconception in how it actually works, which makes it much riskier than you might realise. So if you have a big chunk of your portfolio sitting in it, I suggest you check out this video next.